Thanks for tuning into this earnings conversation. In steady state businesses, it's very difficult to show very high beta uh, on a quarter-on-quarter basis. At times, revenues might slip up on a quarterly basis, and it might become even more difficult. I guess the COVID-induced period enabled our guest today, to make his company reduce some expenses, as a result of which, even though the revenues have stayed flat, the margins have expanded, and commensurately, the bottom line numbers look better than what the top line numbers do. The question is, how easy or difficult it is to try and predict what could happen in the quarters to come. Well, let's pose that question to Mr. Kumar of CAMS. He joins in right now to speak about his thoughts on how the quarter went by, how the quarters ahead could be like. Mr. Kumar, good having you. Thanks for joining in. Hope all is safe.
Hey, good morning, Niraj. All well, and I hope all is well with you. Wish you and your viewers a very happy Diwali.
Yeah, to you too, in advance to you and yours. Talk about whether you believe that the Diwali and the festive quarter could turn out to be a good one, because as I look at the quarter gone by, um, maybe the top line growth and symptomatic of what's happening to the mutual funds, or what happened to mutual funds AUM then, has stayed flattish.
Yeah, so if you look at the quarter just gone by, and if you focus on the first half, I guess it was all gloom in April and May. Things began recovering June onwards. And now, of course, in terms of mutual fund assets, I think the key metric, which is absolute assets, the size of the assets, is back to the pre-COVID time. So that's one important metric which has delivered itself. Uh, Save for equity, which is still trailing the past peaks, it is still not at that level. Everything else on the overall mutual fund asset size looks good. CAMS's share has expanded slightly to about 70%. We were 69 and some change at the beginning of the year. But through the COVID times, we've been able to gain share a little. So that's at about 70% now. Our digital assets have done very well. Our digital properties, GoCorp, MyCamps, and H360, consistent with the digital drive of the industry, have continued to scale and deliver, and they're all expanding their share. So overall, in this context, you see a flattish revenue over the same quarter last year. But the way I would postulate is that the small revenue contraction that happened was in the low yield revenues, the out of pocket expenses, the transaction processing work that we do for insurance and mutual funds. But the high yield revenue kind of stayed. And that, put together with the fact that some of our automation initiatives began to kick in, and we did some consistent cost management, and again consistent with the times, like everyone else was doing. And when you put these three forces together, you see what happened to the bottom line. We believe the results are very satisfactory. We've delivered a PBT of 66 crore, which, if you compare over last year, is 12% up. PAT is 15% up over last year at 49 crore. And we've just declared a dividend of 6.75 rupees per share on a 10 rupee EPS. For the coming quarters, we believe that if the momentum continues and does not significantly expand, but if it continues and stays, and the selling process in equities and SIPs repairs itself completely, it's repaired itself substantially, but not fully, then the quarters ahead could kind of augur for better times.
Um, can you talk about the low yield versus high yield revenue bit that you spoke about? And I'm just trying to understand that if indeed the things that are going to make a comeback also include some portion of the low yielding revenues which took a hit in the first place, would it be safe to assume that if growth were to come back, maybe the 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 operational metrics will not go up in the same way, because you already shown a bit of a jump via internal control expenses, I believe.
That's correct. When things come back, especially in the physical mode where people walk into our branches and submit paper transactions and those kind of things, it's quite possible that the low yield revenue will expand back. Just to kind of give you one metric, our paper transactions are at about 60% of the pre-COVID times. We believe they could expand another 10 to 15% in the next 3 to 4 months. Will they come back to the same percentage as they were 1 year back is a question we have to answer. But the short answer is yes. The asset expansion could yield to a high yield revenue growing. but the low yield revenue could also come back. And to that extent, the EBITDA expansion that we have seen from about the 38% that we've consistently delivered in the past to about 1.7% up to 39.7, a lot of that has happened because the denominator in the fraction, the low yield revenue is contracted. So we believe that 38, 39% EBITDA is a more sustainable number for the ensuing couple of quarters.
Okay, I was going to ask you that most of your peers in India Inc. say that they have been able to identify some good costs and bad costs, and I think the bad costs have gone away. Some of the good costs might come back. So I'm guessing your statement about the stability of the EBITDA margins at 38, 39% indicate that some of the good costs might come back. But you would welcome that, I would presume.
No, absolutely, absolutely. We will welcome that because the capex cycle in technology and security has to gain momentum. It has been slightly muted in the first quarter and the second quarter, but it has to go back, and we are taking it back as of now. And secondly, skill expansion, team expansions in the same areas of cloud, AI, and specialized niche skills has to come back. So you're right. The good cost has to come back for the business to continue delivering in a robust way in the changing times. And I don't think there is any avoiding that.
Just wondering, I can understand that market share gains or losses in your business would, I mean, the large jumps would probably not be there because people may not shift too much unless there is consolidation. But I'm wondering if indeed the large portion of your clients are doing well and therefore the AUMs in their funds would be increasing. I'm guessing that's probably one way of you as well expanding the market share, right? So would you reckon that large shifts in market share for on the downside or the upside are ruled out, but incremental gains or losses could be seen in quarter three and quarter four?
Yes, absolutely. You're right. Just as a principle, market share typically gets traded at the rate of about 1% a year. It is very seldom any faster than that, and largely led by how the core franchise of the mutual funds is doing, rather than our ability to select clients and bring on board fresh ones. Like, it's a relatively low churn industry.
Yeah. Okay. I have a bit of an insider question to ask you. I'm just trying to understand. The market has been off late obsessed with platform businesses. I mean, call it because of Silicon Valley or geo platforms or whatever. Now, your business gets branded as a platform business. Just trying to understand in conversations that you as a management have with investors who are trying to look at, you know, to get a piece of your pie for a really long term, etc. What is it that they are watching out for when it comes to delivery from your end? Where is it that there is a match, and where is it that people are believing that there could be some distance to go before the two ends meet, so to say?
No, sure. Great question. Think of it this way that while it's a platform business, there is a thick stack of services that we provide, of which we alone are the providers, and there's just a wide spectrum on the liability side of the mutual funds that we deliver. So today, what the consumer, our clients, our investors and distributors experience is less of the platform, more of the service stack. While the platform itself is important because that is the core engine which keeps the franchise running. I think even from the investor perspective, they are able to see it as a blend of A and B, which is the platform and services component. Over a period of time, the platform has to become a lot more potent and powerful, which it has been becoming in the last 5 or 6 years. And if you had the same conversation 5 years later, I would kind of postulate that the platform has a lot more significance in the overall business than just the services component.
No, I'm also trying to understand your digital properties that you're launching, right? I mean, uh, any of the two or three that have done well, as I read out in this quarter as well. I think you are on record saying that my CAMS or GoCore, or for that matter, Edge 360, all are doing well. My question is, if you indeed your platform is as sticky as it is, and the services that you provide only garners the regular quote unquote traffic of sorts back to CAMS, would it enable you to maybe launch more service led digital properties? Could each of the ones that have been launched right now become much bigger than what they are right now, grow disproportionately? Anything, any insight that you can give us on that?
No, sure. So think of it this way, that these digital properties are the face of the business, but are not the entire business. They are only about transaction sourcing or transaction origination, which is a component, a small component of the overall scope that we perform. But they are the face of the business. Everyone sees them, and therefore they become salient. Can they grow disproportionately? The answer is yes. But it has been a splintered market in transaction processing for a long time. There are a variety of platforms out there. The stock exchanges do similar work. So do we. There is still about 25% of paper traffic happening there. So for one person or entity to gain salience in that small scope, I think is difficult. It will continue remaining fractured. But then think of it this way: that's probably 5 to 10% of the overall scope that we perform. The broader scope is much bigger and stays slightly away from common sight.
Okay. So as we wrap up, Mr. Kumar, when I look at the quarter, very strong operationally, and therefore that 15% bottom line growth as well. Um, with an assumption that revenue growth does come back in quarter three, but margins cool off a little bit if they do, would it be safe to assume that you may not be able to replicate 15% bottom line growth, but the revenue growth coming back might help uh, the performance on the bottom line? And also, if you are in some position to tell us, based on your past experiences, how is H2 placed versus what you've done in H1?
Sure. So let me tell you this, that cost management alone does not make a P&L, like you know. Revenues have to grow. So that is the first metric that we are looking at. And I think the slightly heartening news is that as you come out of the second quarter and look at the last 45 days, all of October and part of November that we have traversed, I think the trend has sustained. And again, it's too early to call victory. It's too early to say that, you know, the restoration is complete. But we believe that even if sustenance is possible at these current levels, not at a level 45 days or 45 days ago, but at the current levels, we could see revenue growth happening in 2H. And when that happens, I think that's a more northward pointing metric overall for the business. And that will then
Yeah.
lead to overall revenue and margin expansion, absolute margin expansion.
Okay. In which case, while you're not saying it, I would presume that you are reasonably confident about the bottom line numbers growing as well in the second half.
Well, we will see. But yes, absolutely hopeful of that.
Hope for that. Fair call. Happy festivities to you and yours, Mr. Kumar. Thanks so much for joining in, and stay safe.
Appreciate your time, Neeraj, and appreciate the opportunity to come in front of your viewers. Thank you very much.
Pleasure is ours. Thank you so much. And viewers, thanks for tuning in to this earnings conversation with CAMS. It's interesting what the management is saying, that maybe some of the good costs might come back, but with that, if revenue growth comes back, it is something that they would welcome. Don't expect exponential growth from the services, naturally so in that sense. But yes, the mutual fund AUMs are back to pre-COVID levels, and that should only augur well for business in quarter three at least, and maybe going ahead. Thanks so much for tuning in, viewers.